A recap on IAS 8 will be the main section of today. So IAS 10, not it. IAS 10 talks about events after reporting period. Reporting what period? Wow. Events after reporting period. By the time did not come in. All right. Events after reporting period. That's IAS 10. Very short and an interesting topic. So we are saying that the financial statement that we are going to present to the users, they are going to prepare for a period of 12 months to cover 12 months at least. Then let's assume that we start your year at January. So December, that's the year end. So in December, that's where you have to prepare the financial statement. So 31st December or the last day of your reporting period, that's where you prepare your financial statement. Good. So we call this date preparation date. Preparation date. So the date in which you prepare your financial statement. If you prepare December 31st, last day of December, where exactly are you going to publish it? Why are you going to issue it for public domain or for the general consumption? In fact, anywhere your financial statement end, the next quarter, that's the at the end of the first quarter of the following year. So here, the next quarter will be at the end of what? March. Good. So at the end of March, so last day of March, the financial statement will be published in the newspapers or through other media. Now, if you publish it here or issue the financial statement here, what do you think will happen between the date that you prepare the financial statement and the date that you publish it? Issue it. Now, auditors have to audit it, authenticate the financial statement before you publish it, right? Because you cannot publish unaudited financial statements. If you were a type of company, if we're a limited liability company, the law instructs you or the law says that the financial statement must be what? Audited. The account must be audited. Good. So between these two dates, one, the financial statement must be prepared. Two, the financial statement has not been what? Published. So we have prepared it and then they are doing what? Verifying the items in it. So any transaction that occur between these two dates, they are called what? Event after what? Reporting period. You are done. Good. Now, these events, how do we treat them? IS 8, sorry, IS 10 prescribe the correct accounting treatment of such transactions. So basically, that is it. So events after reporting period, they are both favorable or unfavorable events which occur between the date at which the financial statement being prepared and the date at which it's being what? Published. So preparation date and the publishing date. So in between any transaction which occur, then we are done. That's all about events after reporting period. But there are two types of such events. Types. One, we have adjusting events and then non-adjusting events. So adjusting events and non-adjusting events. So I'll start with the adjusting event first, and then I'll summarize it
Please, the definition for the event after.
For the event after reporting period is so event after reporting periods. These are both favorable and unfavorable events which occur. So both favorable and what unfavorable events which occur between the date at which the financial statement is being prepared and the date at which the financial statement is being was published or issued. So events which occur between the date at which the financial statement is being prepared and then the date at which the financial statement is being published. Let's assume that your financial statement ends at September. If your financial statement ends at September, meaning 3 months after September will end, that's October, November, December. So December you have to publish your financial statements. That's good. So that is now let me take it again. So the events after the reporting period refers to both favorable and what unfavorable events which occur between the date at which the financial statement is being prepared and the date at which the financial statement is being what published or issued. That is it. Now adjusting event. You're an adjusting event. Now with adjusting events, it will occur after the reporting period or after the year end, but it will provide some sort of what evidence of its existence before the year end. That is it. So adjusting event refers to events after the reporting period which provide evidence of its existence before the year end. So although the transaction will occur after the year end, let's assume that this is 2020, this is 2019, this year is 2019. Even though the transaction will occur somewhere 2020, but there's an evidence that such transaction or this transaction exists even before 2019 end. Yes, so that is it. So it's like the goods is in 2019 that the actual issue occurred in 2020. So it means that there's evidence in 2019. Now, that is adjusting events. So anytime there's event after the reporting period or there's a transaction which occurred between the date that the financial statement is being prepared and the issuing date, and such event will provide evidence or there's an indication, there's something that suggests that, or there's an evidence that suggests that this transaction which was occurred after the reporting period exists. Yes, so that is it. Now, what's the accounting treatment? As the name suggests, adjust. So the accounting treatment is what? We have to adjust the financial statement. Why? Because 2019 financial statement had already been prepared. And then it's with the auditors. They're auditing it. Yes, the transaction was okay, but it's for 2019. So what do? Let's call for that financial statement and do what? Update it with this transaction. So record it or adjust what the current year financial statement. That's 2019 financial statement. That's the accounting treatment. Now, what you have to know is that you have to familiar yourself with the basic examples of what the event after reporting period, so that when you examine locate them in your question, you should be able to what determine whether this is what adjusting event. That is it. So let's go to some few examples, specific examples. There are about five stated in your in the standards, and then you are fine. So examples of event afterward reporting period. Example of event adjusting events. settlement of court case after the year end. So A, settlement of court case. Settlement of what? Court case after the year end. Settlement of court case after the year end. Good. Settlement of court case after the year end. That is the first example. Now, all of this, there must be evidence of existence. So we normally add a clause that if there's an evidence that there's a pending court case, right? Now, there's a pending court case in 2019, just like in December, the judge has not what, pronounced the judgment. So we don't know whether we are going to win the case or we are going to lose the case 50-50. But shortly after the year end, January 20th, the judgment was passed, and then it requires us to pay 50,000 cedis to compensate the other party. Good. I think there's a question here. So, settlement of court case, pending court case after the year end. So, just 20th of January, the judge pronounced the judgment, and then you have to pay 50,000 to compensate the injured person. Good. Now, the issue is this. Now, the financial statement had already been prepared. So, what do? Now, because before the year end, that case was still pending. And that case, you are still dragging it every day. You are going, claiming that, or you thought you're uncomfortable with, not knowing, not at all. Yes. So what do? But there's an indication that you may what, pay a certain amount as compensation when you lose the case. That is it. So that's the first example. Example 2, or second example, is impairment of assets shortly after the year end. Impairment of what? Assets shortly after the year end. Impairment of assets shortly after the year end. All this, there must be evidence that this impairment exists before the year end. Impairment of what? Assets. Shortly after the year end. Where there was what? Evidence. Where there's what? Indication. So where there was indication. Where there's indication that the assets may have impaired before the year end. Where there's indication that the assets may have impaired before the year end. So that is it. So impairment, that's example 2. Now let me give example. Now the impairment of assets can come in 2 folds. So impairment of assets. Impairment of assets. After the year end, you have some goods you are selling, inventory, and then before the year end, these goods were showing symptoms of what? Outmoded or absolute. Now, assume that the current amount of these goods, the cost of these goods is 20,000. And right after the year end, you sold the goods for what? NRV. You sold the goods for 15,000. So he suggests that, in fact, these goods that we have carried it in our books, in fact, there's an evidence that after 2019, the goods has what? Has been impaired. So we have to what? Write it down. Because say inventory must be measured at what? The law of what? Cost and then the NRV. So we select the least one. So anytime after the year end, the NRV decreases, the NRV of the goods or the inventory decreases, there was an indication that that goods which exists before the year end, in fact, they're suffering from impairment. That is it. It's like some of the goods, you've not seen it. So right after the year end, you made your mind to probably dispose them off, and then the value dropped. So there's an indication that the goods that you have included in the financial statement may have impaired. That's the example. That's one example under the impairment of assets. So that's one way, inventory written down after the year end. And you can also consider this. When a customer is being declared bankrupt, that's another example under the impairment. A customer is owing you so much, maybe 40,000 cedis, and that customer was declared bankrupt after the year end, or that customer decided to die after the year end. So what do? So here, the customer decided to die here, and owing you 40,000. So it means that, in fact, you cannot retrieve such money or the amount. So it suggests that, in fact, that money cannot be received before the year end. No, because the customers have killed him what? Himself. Unless you do go yourself and then meet him in the graveyard to take your money and come back to life, if it will be possible. That's great, if it will be possible. So that is it. So that's an example of the impairment. Then C, the third example. The third example. So it suggests that bad debt after the reporting period must be adjusted. Is what? Adjusting events. We are listing the adjusting events. Then the C is the profit sharing after the year end constructively. So where there is what? Routine and regular sharing of what? Profits or bonus. If every year, if every year after exams, your what? Or your kids, when they score high, you do a party for them. Every year, that's what we do in the house. But as soon as they fail, no party. And and then there was one day that the results came in after you have spent all your money. And then they passed, in fact, superb. And the kids are asking for their party. And you told them that you owe them no liability. No, constructively, routine. Your past actions suggest that that is your habit. Your past action suggests that anytime this thing happen, anytime when they score well in the exams, me too, I'll do party for them. That is what. This one is under IAS 37. Good. So there's a present obligation. Now the issue is this. Let's bring it in business terms. Every time you are paying bonus after the year end. Every time you are paying bonus after the year end. Now we are saying that This bonus that you are paying after the year end, even though you paid it here, you paid it after, because you determine the profit first, go and sit on the AGM and declare the last year's bonus. Good. So even though you declared it after the year end, there's an evidence that, in fact, you owe the employee bonus. Why? Because before the year end, they know that it's in their mind that our boss there, I don't know every year there's bonus. Most of the organization, whether they score well or not, there's bonus. So such situation, there's an indication that you owe them a bonus because that's your habit. So even if it's okay after the year end, it's still what adjusting event because there's what indication or there's what evidence. I will get it. So that's what bonus or profit sharing after the year, but it must be routine, not once a while. Pass it on, no. So that is it. So bonus or profit sharing. Now it must be routine. It must become your habit. Good. Before we can say that that's what a present liability. You have present liability. Good. So that's the example that we will consider. That's the example that we will do what consider. Then let me the last two, then we are done with the adjusting events. Example number 4. Now, let's assume that you have ordered for some goods and then outside the country, not even, in fact, internal. And then you pay everything and they promise you that they will deliver the goods before the year end. They've sending the way bill. In fact, all the title deeds is in your name, and then you have hold of it. But the goods physically have not arrived. Shortly after the year end, in fact, they promise you that the goods will arrive 20th of December. In fact, 31st December, the goods have not arrived. The goods arrived on 20th January. 20th what? January. Good. Now, when the goods arrived, are you going to add these goods to 2019 financial statement or you add it 2020? But it's part of 2019. Why? Because there's no evidence that these goods exist, just that physically the goods are not arrived. But the source document, receipt invoice, way bill suggest that these goods are with us, just that physically some transit coming, right? So it must be part or adjusted. So that is it. So we say sales. Sales, receipt of what? Sales or purchase after the year end. After the year end. Receipt of what? Sales or purchases. Receipt of what? Sales or purchase after the reporting period. After the reporting period. Good. Now, a typical example is this. You bought some goods. The goods are in. Just that the details that suggest that you have those goods, you kept them in your safe or your document, and then it was not included in the total goods of the entity. So it means that that goods was omitted. Just that when the auditors were going through the receipt and then they realized it. Good. So it's event after what reporting period. But those goods exist. Just that it has not been included. You realize it here, right? Good. So that now let's go to the last aspect. It talks about fraud. Fraud or errors or mistake notified after the reporting period. So if there's any fraud that is notified, or that render the financial statement incorrect, or any error that render the financial statement incorrect, it must be what adjusted before you publish the financial statement. So if finish preparing the financial statement, but it suggests that there's some error or fraud that you've identified, which by all means render the financial statement was incorrect, then what do? Then you have to what? Adjust the financial statement or correct it. We are done with the adjusting event. So these are the examples. These are the specific examples enshrined in the standards. And then don't forget the rule. The rule says this. Even though the transaction will occur after the reporting period, there must be evidence before the year end. That's the rule. Good. Now let's see. So non-adjusting events. Non-adjusting events, on the other hand, refer to events after the reporting period which provide evidence of their existence after the year end. So for non-adjusting events, it will occur after the year end and provide evidence of its existence after the year end. So for non-adjusting events, it will occur here, but it will provide evidence that it exists after the word is what? After the reporting period. So this is the error of what? Non-adjusting events. Non-adjusting events. And then this is the arrow of what? Adjusting events. Have you seen? So this is the arrow of adjusting events. Non-adjusting says that it will occur after the year end and still provide evidence that it also exists what? After the year end. That is it. Good. Now, what are the examples? The critical examples of what? But I'll walk you through just two, and then we are done. The rest is question solving. I'll walk you through two of the non-adjusting events. Non-adjusting events. So, example number one, dividend. 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 So that's the examples of what non-adjusting events. So non adjusting event. Example, dividend. Let's assume that 2019, not even we should assume. That's the fact. 2019 dividend will be declared in the first AGM after 2019. When they know their stand, their financial statement will be prepared, they will base on it and then declare dividend. Good. So 2019 dividend will be declared in where? 2020. Maybe it was declared in 20th of January, where they are done preparing the financial statement. Then they know their stand. Good. So when they declare that dividend, in fact, the directors will make a clear statement that this dividend that we have declared it in 2019 or declared in 2019, in fact, it's in respect of what? It's for 2019 financial year. So will it be adjusting or non-adjusting? In fact, the issue is this. Even though the dividend declared is for 2019, there's no evidence that before 2019, that's 31st December, before 31st December, they were owing dividend. No. Dividend is not constructive. Dividend is a matter of what? Policy and decision. It's not constructive. It's not something that every year they must pay dividend, so they owe you dividend. Not at all. They don't owe you dividend. They have to make a decision on it before they declare the dividend. So even though they've declared it 2020, there's no evidence that suggests that they are owing a dividend before the year end. So there's no evidence, even though the dividend is for 2019. So here it is what non-adjusting event. For non-adjusting event accounting treatment, you disclose, you don't adjust. In fact, you do nothing. Examination purpose, you do nothing. But in reality, you disclose. If they are material, tell the users that, hello, users or shareholders. At the time that we are preparing the financial statement, there was a material transaction that occurred after the reporting period, but it's non-adjusting. You want to bring to your notice, you are done. So non-adjusting events, you have to do what? Disclose. Yes. And an example is the dividend. So anywhere, so on that note, anywhere you stand to declare dividend is for that particular year. So if you declare dividend in 2020, it's for 2020 financial year, accounting purposes. Then the next example that we look at it is the going concern. Going concern. Going concern trade. Going concern trade. Going concern trade. Good. Going concern trade. Now use COVID-19 as an example because that's create a lot of going concern threats both on human life and corporate life. Companies, they are collapsing, human beings are collapsing. Yes. Good, so it's a going concern threat. Now, after the year end, if there's any indication or there's a loss, a specific loss, it must be what disclosed. Now, let's cite example. Let me start the example. You started 2019, nothing happened. December, you pay your financial statement, nothing happened. March, you publish it. But before you publish it, 20th February, COVID-19 started. And then from 20th February up to first week in March, you've lost, let's say, 800,000 Ghana cedis. That's from 20th of February up to first week of what? March. That's your loss. So you are saying that this loss is material. So let me adjust the financial statement. No, this is a going concern threat. After the reporting period, if there's anything that suggests that your survivor is in doubt, it's a going concern threat. And a clear example is the COVID-19. So you realize that entities prepare their financial statement December, and then between February, March there. In fact, in our part of the way to not experience it around March there. We had our own April, May, June there. Good. But where the issue started from, in fact, they had their men starting from where 15th of January up to date. So now, all what you are saying is this: any loss after the year end is not an adjusting event. Do not adjust the financial statement. Meanwhile, it's a going concern trend. It indicates that your survivor has a question mark or is in doubt. So your going concern is in doubt. So what do? Do not adjust the financial statement that you are losing 800. No. Instead, instead, use what you call IAS 8 and you've done it. Change accounting policy. Now change your policy from going concern to breakup basis. Oh yes. Going concern to what? Breakup basis. Because you know that now your survivor is in doubt. Hardly for you to survive in this COVID period. So now that means the financial statement that you prepared on going concern basis, change that assumption to that of what? Breakup basis. Because we said that in the conceptual framework that if you know that your survivor is in doubt, they don't use going concern. Instead, use what? The breakup basis. So that's a clear example. So this is the end of the IAS 10. We are done. So I'll project some few questions and then you let me know whether they are what adjusting events or non-adjusting events. Then we are done. Good. So you see the first question very soon. Yes, if you do have any question, kindly let me know. So let's pick our first question. So kindly take a screenshot of it. I may take it off. So in accordance with IAS 10, which of the following events will be classified as what? Non-adjusting events in Marco's financial statement. Great. Okay, good. Let me screenshot them. Send it to you. So wait, now let's solve it. Now, during October, there was evidence of permanent diminution in the carrying amount of a property held as at 30th of what, September. Our financial year ends as what, September 30th. So even though October, that's exactly after the year end, then we notice, so it's event after reporting. But there's an evidence that before the year end, that property has been what, impaired. So A is part. Now I'll jump B. C is A is adjusting event. Then B, I'll jump for now, even though that's the answer. I'll jump and come back. C, sale of event during October 2003 at a value less than 8 cost. The inventory was included in a financial statement at cost. So this one, the solution is on the board. We said that impairment of what? Assets. And we give example. Two situation. Impairment of assets after the year end. And then a typical example is after the year end, when you dispose of your goods below what the cost, below the cost. So after the year end, and then we give example that maybe the cost was 30, you sold it for 20 after the year end. So that one, and then when the customer decided to do what? To die or bankrupt. These are the two examples of what? Impairment of asset. And all of them was inside. Now, when you pick the D, this says that the insolvency of a major customer during October 2003, that's what? Bankrupt. Or he decided to die. Or he will not pay you the money. Whose balance was included? In fact, his balance is inside. So the receivable figure as at what? 30th September. So it means that there's an indication that that value which has been included has been what? Impaired. So it means that A, C, and D are what? Adjusting. So let's do elimination by wrong tactics. What are they asking for? They're asking for non-adjusting. And now we've identified the adjusting. So the remaining one is what? Non-adjusting. Yes, indeed. B is non-adjusting. On December 2003, the acquisition of subsidiary was completed following lengthy negotiation which began what? September. So even though they started the acquisition of the subsidiary, the acquisition was completed in December, but there was no evidence. In fact, anytime we are doing restructuring, until the process is completed, until the process was completed, you are not done. How we get it? Good. So that's fine. So it means that it means that there's no evidence of the condition exists before the year end. So nothing suggests that they've acquired what? A subsidiary before the year end. So that's the answer. Great. Okay, good. I'll take the C again. C. C says that the sale of event during October. Now, anytime after the year end, afterward the year end, you have a goods or asset that the value drop in the asset value shortly after the year end. In fact, that asset value must be what? Adjusted. Let me give you two practical examples. You have inventory. The cost is 30,000, 30 Ghana cedis. Shortly after the year end, you sold it for 20 Ghana cedis. So it suggests that that 30 that you have included in your financial statement, it must be at what? 20. So it has not impaired. Just that you realize this impairment after the year end, when you dispose of the goods actually for 20, before you realize that no, the value has what dropped. But there's an indication that that 30 that you have keyed it in is not 30. Another example is when a customer, people who are owing you is 50 Ghana cedis. But there was one customer who owe you 10 Ghana cedis. That customer was declared bankrupt shortly after the year end. So that customer cannot pay that 10 Ghana cedis that is owing you. So it means that the value of your asset that you are yet to receive from that customer will drop. Definitely it will drop. So when it drop by what? 10 Ghana cedis is what? Adjusting events. And this is the example that they provided in it, saying that the sale of event during October is after the year end, at a value less than the cost. So the NRV is lower than the cost. So that means the goods had already impaired. This inventory was included in the statement of financial, so in the financial statement at the cost of, at cost on 30th September 2003. So it make it what? An adjusting event. And then the insolvency too is an adjusting event. So that is it. Good. Now I will bring the next illustration. For the next illustration, let's see. Let's pick the next question. Now, question one of the footnotes. Good. Now, we are preparing the financial statement for, sorry. Okay. Now, let's see note 10. Note 10. Let me copy it and then paste it on the platform. This one, I'll just copy it. Good. Note 10. The last footnote. Okay, the last footnote. The last footnote. Okay, so it's there. Apart from the interim dividend paid, which is shown in the trial balance above, a final dividend of 3 pesos per ordinary share was proposed in April 2019. Okay, April 2019. We are preparing the financial statement for the year ended when 31st March 2019, right? But they declared the dividend when April, so it's after the reporting period. Meanwhile, they will tell you that it's for the preceding what year. So it means that this is an event after what the reporting period. Will it be adjusting or non-adjusting? Non-adjusting. Okay, that's friends in person. Good one. So let's see. I like that. In fact, answers are flowing. I like that. Answers are flowing. Good. So I will take that. Uh-huh. This one is a bit straightforward. So I think the answers are coming. So what will be your answer? It's non-adjusting event. So it's non-adjusting. Correct one. Because dividend declared after the year end has no bearing or there's no evidence that suggests that the company is owing what dividend for the year end. Good. So that is it. Now let me show let's go to the last illustration for to end. The remaining one I will present them to you. I'll present the remaining ones to you. Okay, so let's see this question. Let's go to the last part one. Good. Let me also copy this one. This one is a note that will be attached to your financial statement. So when you see them in your financial statement, what do? You do nothing. So that note will not be touched. If you touch it, it's on wahala. Okay, so this one too, what will be the treatment? So let me post it here. Good. So it's N. This one too will be great. A final dividend of 50 pesos per ordinary share was proposed by the board on 15th February 2019. In respect of 2018 financial year, this transaction has not been recorded. So you have to record it there. So this one is what? Non-adjusting what? Event. So that is it. Good. So great. Now this is how far the good Lord bring out the question solving stage of the IAS 10. You can go through the past question to get more. Let's try this final illustration. So now question D. Let me okay. So we are doing the D. This is coming from the past question. Great. Okay, great. Let's take the comments again. Required. Discuss the effect of each of the above items on the financial statement of Swami Limited for the year ended 31st October 2015 in accordance with what IAS 10 events after reporting period. Now let's see. Swami Limited is a listed telecommunication company which prepares its financial statement for the year ended 31st October 2015 in accordance with what IFRS. The financial statements are due to be authorized for issue on 15th of January. Good. On 15th of what? January. Now let's see. Swami Limited holds an investment in shares of a listed company of Asafo Limited during November 2015 there was a material fall in the value of Asafo Limited shares. Analysts attribute the fall in value principally to a fraud dating back to December 2014 that was discovered by Asafo Limited management and announced publicly in November 2015. Good. That's after the financial statement had been prepared. Then two, in December 2015, the directors of Swami publicly announced a plan to reduce the workforce by 10% as a result of what? Worsened economic condition, like the COVID. So redundancy. Now this is your trial. You are trying this one for me. Good. So let me know the final answer. Let's take just a minute to go through. Uh, but all the two are non-adjusting. Now let's explain. Huh? Yes, it must be with the financial statement. It occurred 2014, not this year's financial statement. I will get it. Good. So you are fine. Now let's see. Swami Limited hold investment in shares of a listed company. Asafo Limited. During November 2015, there was a material fall in value of what? Asafo. So during what? November, the value what? Dropped after the year end. The value did not drop before the year end though. The value did what? Dropped after the year end. So if there's indication that suggests the existence of the transaction after the year end, then it's what? Not adjusting. So if say during November, during what? November, there was a material fall in value of Asafo Limited shares. Analysts attribute analysts or financial analysts or business analysts attribute the fall in value principally to a fraud dating back 20 or December 20 or 14. But we are preparing a financial statement when this financial statement is for 20 what? 2015 November, right? Yeah, the year end is 2015 November. So 2014 is a year ago. A, a year ago. Good. A year ago. Great. So that was discovered by Asafo Limited management and announced publicly in what? November 2015 when they announced it. So they announced it after the year end, November, because we prepared our financial statement in October 2015. But then we are then preparing our financial statement. Good. So the I is what? The first one is non-adjusting event. Why? Non-adjusting event. Because tell the examiner that because the fall in value relate to condition that arose after the reporting, because they say during November 2015. They didn't say what the fall is attributed to condition before the year end. Good. Now, the fraud itself is adjusting event for Asafo. How we get it? This question is in two folds. You bought a company and there's a fraud in that company. So it's an adjusting event to what? That company Asafo Limited, but not you, the parents. How we get it? You have an asset. You are holding that company as an asset, okay, as investment, a subsidiary. So in short, we will tell the examiner that the investment in Asafo, the value fell since it indicates that, or since the evidence suggests that on November 2015 the asset value has not dropped. But however, to Asafo Limited, there's adjusting events. How we get it? Because fraud. That suggests that the financial statement that we have prepared contains what? Mistake. How we get it? So we will try more. Okay, fine. Now let's see the second one. Now the second part two is what? Non-adjusting events. The second part is non-adjusting, and most of us had it correct. So let me pick one of your solution and see if the explanation is okay. Friend in person, any explanation for us? The good. Now with the second one, as soon as you announce restructuring, there is constructive and legal obligation on you because the law will tell you to make certain provisions. So legally, there was obligation on you, or legally, you have to make certain payments. Now, however, this issue or this restructuring was announced in when? December what? 2015, where we finished preparing the financial statements. So before we prepare the financial statement, that's November 2015, there's no indication that we are going to sack our employees or we are going to create a redundancy. Or you can also explain it from the going concern threat. That's the going concern threat, and then it must be what? Disclosed. So that is it. And then you are fine. Then you are fine. Good. Now we are done finally with that of the question solving stage. So I'll be sending you more questions on that, and then you are fine. Good.